Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, September 16th. It's currently about 1:45 in the afternoon. Outlook tonight, market's going to struggle to determine what factors we're supposed to be looking at. I have said before, and I'll say again and affirm what I've seen in the last several weeks, and I think the price action is not being driven by day-to-day weather forecasts. Every single day, we talk about weather. Every single day, the weather forecasters search for something bullish to talk about, and the market wants to see something bullish in those forecasts, regardless of what region of the world they want to look at. But the reality is, the markets have not been trading day-to-day weather forecasts in any sort of discernible, clear-cut, attached to the hit type of method for several weeks, maybe close to a couple of months. Even though that's what we talk about. From a weather perspective today, as far as the U.S. is concerned, there's really no problems or concerns in the forecast as far as harvest is concerned. There's certainly parts of the plains that would like to get more moisture for the winter wheat seeding. The marketplace wants to every single day talk about South American weather and immediately transition from summer drought concerns in the U.S. to concerns about a drought in South America. I don't think the market action is following that type of storyline at all, but it's something that's being talked about. To the extent it's being talked about, the forecast there really don't offer anything of significance. It's too early in the season to be concerned about forecast there. The marketplace has been trying to be concerned about dryness concerns there. If you're one of those that's following that storyline, today's forecast there is probably wetter than it was Friday. I don't think it's a factor, but it's something that's constantly talked about. So I don't see weather as an influence tonight, but if you're looking at for weather influence from a U.S. harvest perspective, there's nothing there concerning harvest delays at all. As far as new fundamental news, last week we had the USDA reports. Price action following that got a boost in beans, but failed on Friday to maintain all of the boost received on Thursday from the reports. You've got U.S. production figures fully known. Corn has not performed well for the last several weeks. It's been underperforming expectations. You had a bearish reaction to the report initially. You got a two-day recovery Thursday and Friday after that, but the problem is there's only like 3 closes lower than Friday's close in corn since mid-July, and if that means there's an awful lot of speculative longs that are trapped above the market with a losing position. In fact, Friday's close was the lowest Friday settlement in December corn since the early days of July. This is not the type of price action that's been expected by the trade. It's not the type of price action expected by a market that has been saturated with one-sided thinking, bullish-only thinking, and yet here we are. The reports and the size of the crop seem to be fully known. Harvest is beginning. It's expanding. You can argue about what the yields are in terms of their exact impact on national yield calculations. Obviously, we have sharply reduced yields in most locations, but what we do have also, seems to me, is we have more of the better than expected themes developing as harvest progresses here than what you were led to believe by pre-harvest expectations. And to that extent, it doesn't mean that the crop is significantly larger than expected or anything of that nature. What it does mean is traders may have already discounted the worst case scenarios in terms of production. That, along with price action that's been underperforming expectations, charts that are rolling over and trapping longs above the market, and having all the reports come out, and there really isn't a new storyline to talk about in terms of the crop getting smaller. All of that leads to a situation where we are more prone to additional liquidation pressures here in the weeks ahead. Dees corn is trading at around 780, give or take. Downside risk, people will hope that we don't go lower than 750. We had a knee-jerk post-report reaction low of just under 760. I think the risk here is that somehow this market unravels and slides further than expected. If we continue to find an idea that yields are coming in a little bit better than worst fears, and if that begins to ration up national yields, that'll further add to the liquidation pressure. It doesn't really change the overall necessity to ration demand. That's not going to change. It doesn't change the idea that maybe higher prices will be needed to ensure that this demand rationing takes place, but all that may occur and be dealt with at a later time. And right now, for the next several weeks, the most important thing that we may still be dealing with is money flow out of the corn market, long liquidation, and price unraveling from that liquidation pressure. So I think that we have to be concerned that over the next few to several weeks we got more downside risk here in corn. It may very well be that during the winter we come back and trade at levels equal or higher than where they are right now. That there's a strong case for that happening, but right now I think the liquidation pressure is the biggest concern. As far as soybeans are concerned, the trade is really very bullish, has been before the last week's USDA reports, was even more so after seeing the USDA reports. The Fed action to add QE3 and has led to another round of commodity inflation expectations. That impacted the trade on Thursday and Friday as well. But all things considered, soybeans are not performing that well. And we're up at price areas that we've been at before. We're not making new highs. We're not going to build new energy here. We really are not going to get the type of new buying energy that we need to both sustain current prices and to talk about pushing up another $1 or $2 or whatever target you want to use. And soybeans are right now experiencing the same thing corn did several weeks ago. It's having a difficult time going higher on new bullish news. And I think the concern here is that beans are going to have to go through another liquidation phase as well. The market's tried to throw smaller U.S. crop sides at this trade. They've talked about a weaker U.S. dollar, more Fed loose monetary policies. We're already trying to talk about South American dryness concerns, but the market is not responding in the way that they expect. And yet everybody's bullish beans and the longs have large speculative positions on there. So I think that the risk here remains that that market's going to experience liquidation pressures. As far as fundamental concerns, yes, we've certainly got a short crop in the U.S. There will be fears about South American problems, but it's interesting that even in last week's USDA report, the global carryout in beans versus last month versus last year are virtually identical for this next year's level. And most of last year was spent sub $15 on soybean futures, and it wasn't until we had a summer drought that we got to the levels that we're at now. And so when you look at the raw fundamental data, until or unless you get a South American problem, I'm not sure it warrants higher price levels than what we've got. And it may very well be that current price levels are very susceptible to some sort of sell-off and liquidation pressure because we're just too far away from getting a South American weather storyline, problem storyline to get traction. So I think over the next several weeks we may have a situation where the market is loaded with longs, doesn't have new fundamental news to unfold, and it's too far away from a South American time frame that warrants the scrutiny of day-to-day and hour-to-hour weather forecasts. And I think that opens a door where we have a window of opportunity here, or a window of vulnerability here, for a liquidation break. And if that is true, from the current prices that you're at in November beans, to break the market $1.50 or even $2 wouldn't be that difficult to do once things got started and once you started to unravel. I think the biggest key here for soybean prices over the next, say, 60 days is going to be the tone of the Midwest yields as that harvest progresses. I don't think we really have a handle on what that's going to be like, and there's a lot of wide-ranging ideas from producers on the ground as to what they expect their soybean yields to be. So the risk here is that the market has dialed in some very low national yield figures and actually dialed in perceptions that eventually they're going to get lower. And if we are now into harvest and if we begin to get some reports and themes that, hey, maybe these beans are a little bit better than we expected, they're not as bad as our worst fears, I think that will further fuel the threat of liquidation pressure. So as far as tonight is concerned, I would say that we're dealing with something that we may see trade on both sides, but I think you've got selling interest that's going to be building above the market for multiple factors. Most of the reasons are associated with price action that it's faltering. Looking at beans on Friday, very poor performance in relationship to expectations. Looking at corn in relationship to the last couple of weeks for expectations, market is performing poorly, and we've got too many longs above the market. I think we've got long liquidation to experience. So I'm not saying we can't trade on both sides here tonight or early this week, but I think we start out a little bit weaker, and I think there's also some euphoria in the trade left over from last week on this Fed action for QE3 that I personally think is not grounded very well in an understanding of what the Fed did and what the implications are for the economy ahead. I think there's far more concerns about the U.S. congressional action or inaction regarding the fiscal cliff of the Bush tax cut renewal, and so I think that's going to become more of an issue looking forward. And I just don't think we got the right type of environment where investors are willing to invest in commodities or stocks either, as far as that is concerned. So I think some of the spillover excitement from the QE3, the latest Fed action last week, I think that's going to very quickly fade, and I think you may have some of those initial buyers in the market from last week looking for the exit door here this week. So I would say look for a little bit weaker start, maybe trade on both sides, but selling interest is building above the markets. For the DPP Grain Desk, this has been Duane Lowry. Thank you.